All right, we're gonna pretend like this is a welcome back, even though I never left. You guys just did.
I didn't leave.
So I'm just gonna put the logo up here, back with Kevin. During our little bit of a break, you did tell me that you remembered something more on choosing your lender.
Right. It was more on, do you have to use the lender that the realtor sends you to or refers you to? And that is still a no. But there are instances where a builder or a seller may offer some incentives for you to use their preferred lender. And that is legal because the incentives are going to you. But they can choose to either pay those incentives with everybody or just with one particular lender because they know it will get done. So sellers can also refuse to accept an offer if it's from a lender they're not comfortable with. Okay. So buyers and sellers they make all the decisions. And they can decide, well, you can use anyone you want, but you're not going to get this $10,000 in concessions. So there are some times, and I've actually had it where I've worked with a buyer, got them pre-qualified, walked them through a plan for a year, and then they went and bought new construction where the builder offered them an enormous, up to $30,000 worth of incentives to use their lender. And in those cases, I tell them, you're going to need to go to their lender. But now they're already educated in the process. Yeah. If they have any problems with that lender, they're still welcome to call me. The goal is to get the deal done, even in some cases when I don't do it. It's if someone else can get it done. If it benefits the buyer to go somewhere else, I'll be the first to tell them.
Okay. So in this section, I kind of want to get a little more into the meat of the loans themselves because, good Lord, there are so many. This is such a bigger process than I thought it was going to be, I swear. But first, what do lenders look for? Like, what do they actually look for?
So I try to make everything as simple as I can. My job up front, I am looking for stability. That means, time on the job, time in the field, your residence history, if you've moved around a lot. So stability. Then we're looking at debt to income ratio, which is your total debt divided by your gross monthly income. Then we're looking at assets, money you have for down payment. We're looking at your credit and the collateral. None of us really have a big say in the collateral. That's why we do an appraisal. The real estate agent up front does market analysis so that they have a good idea, but then we do an independent, unbiased appraisal of the property. And I don't even get to talk to the appraiser. So they want to make sure that you're getting a house that is worth and that the lender is making a loan on that. But of all those 5 things, the 3 things that are most important is we look at your credit, we look at your debt to income ratio, because the combination of those 2 tells me how high I can go on your debt to income ratio. So like I said, I always figure your maximum and then what you're comfortable with, and then let you choose. Okay. And then of course, assets I use because that tells me what program is best going to fit you. If you have, a lot of money down, then I'm going to refer probably one program. If you have minimum down, I'll probably be looking at another loan.
Okay. So I think for the purposes of what we're talking about here, I really want to talk on, 4 types of loans.
Right.
Conventional, FHA, VA, and then down payment assistance programs, which is a new thing that I had never even heard of.
Right.
So let's start with conventional because I think at least that was the one that I was the most familiar with. What is it? Who should use it?
So a conventional loan, it's been around the longest. And it's basically just like a loan it's sold on Wall Street. So we all have the same guidelines. But a conventional loan typically fits in that myth about 20% down. I can do a conventional loan with 3% down. The more you put down, the lower your rate and the lower your mortgage insurance. And mortgage insurance, we could talk about that, later. But unless you're putting 20% down, you pay some version of mortgage insurance on everything. But from 3% to 20% or more, you can look at conventional. And they have their own set of guidelines for debt to income ratio and stuff that I might be able to expand by looking at another program. So conventional is a good program. It has some advantages that you can get out of mortgage insurance after 2 years using your new home value, not the value when you bought it, without having to go through a refinance process. The other ones don't allow that. So there's an advantage to that. If someone has a house, say, to sell, and it's not going to sell before, they might say, well, I can only do 3% down. I'm like, that's fine. And then when their house sells, they can make a big chunk down payment and get rid of their mortgage insurance. So there's some advantages to conventional. Conventional has, I guess, more advantageous ways to get rid of mortgage insurance, and it's what most people call your vanilla loan.
Okay.
So conventional is a great program. We use them all the time. The key about 3% is you have to be a first-time home buyer. Otherwise, it's 5%.
Okay. So then how is that different than an FHA, which I think is like first home A?
Right. FHA?
Yeah.
Federal Housing Authority.
Oh.
And so that's a government agency that actually insures the loan. This is a great program. A lot of first-time home buyers use it, but you do not have to be a first-time home buyer. Matter of fact, on any of these loans, you don't have to be a first-time home buyer, including DPA, but we'll get to that. The advantages of FHA, you can do it with 3.5% down. They're more lenient on qualifying. So if you've had a hiccup in your credit or your debt to income ratio is over what conventional will allow, FHA will probably still do it. So FHA is a great for starter homes. They're insured by the government. You pay a monthly mortgage insurance just like you would on conventional, but it goes to HUD, which is Housing and Urban Development, so that if they have any foreclosures, it comes out of the fund that they create by collecting monthly. So it was really kind of initially designed for a first-time home buyer and low to moderate income.
Okay.
So conventional, I don't care how good your credit is and how much you're putting down, I can't go over 50% on your debt to income ratio.
Okay.
FHA, I've done them at 60. So FHA gives more expanded guidelines on debt to income ratio. And so does VA.
Okay.
And so does down payment assistance. That's why I said conventional is kind of your vanilla loan. For an entry-level person, most entry-level people are doing FHA, VA, or down payment assistance.
Okay. And then VA, I believe, is for military personnel, correct?
Right. So either active or retired, could be National Guard, it could be the reserves, but VA is a great program because it's zero down. And so often we get buyers in with no money out of their pocket. Seller may negotiate to pay their closing costs and they don't have to make a down payment. So VA is actually my favorite loan. I wish it was available to everybody, but unfortunately it is just available to veterans.
Okay, does it have different caps in DTI things, or?
So they all have kind of their own set, what we call guidelines, and then regulations.
Okay.
Guidelines says this is what it should be. Regulation says, I don't care how good this file is, you can't go over this.
Okay.
And both FHA and VA, I'll give you an example of that. On a conventional loan, your debt to income ratio, which is again, very simple math, your minimum monthly payments on installment and revolving debt divided by your gross monthly income. And that includes your house payment and everything.
Okay.
Can never go over 50.
Okay.
FHA and VA, I've gone up to 60. I've seen them higher than that because they look at what's your credit score, they look at what's your debt to income ratio, and then a whole nother thing called residual income. How much do you have left over in cash based on your family size after all your bills are paid every month? So FHA, VA, and down payment assistance have expanded into more liberal guidelines for qualifying in debt to income ratio and in credit score.
Okay. Interesting. And then the fourth one, which I know absolutely nothing about, I didn't know it existed, down payment assistance.
Yeah.
What is that?
So down payment assistance loans means that some kind of government agency, in most cases it's the state, is going to give you money for your down payment. Now there's different ways they can do that. You can take it as a second mortgage or you can just take it as a grant. But it's kind of like a gift. A second mortgage you have to pay back eventually. A grant, you don't ever have to pay it back. Interest rates are just a little bit higher, but that's how we get people in that don't have VA and don't have money for down payment because their requirement is the buyer only has to have $1,000 into the transaction. So they'll make your down payment. We could get the sellers to pay your closing costs. The buyer would only have to come in with $1,000. So they're great loan programs, and you don't have to be a first-time home buyer on these programs. But it's the biggest obstacle most people have to getting into a house is down payment.
Yes.
And these programs, and there's multitude of them. There's Colorado Housing Finance Authority, there's El Paso County Bond, there's CHAC, there's all kinds of different programs. They do have some income limits, but the limits are so high that most people that are using them don't exceed the guidelines. So there's advantages to doing the down payment assistance. If that's your obstacle, we can get through that with, and your $1,000 can actually be a gift from a family member. It just can't be from the realtor, the lender, or the government agency.
Okay. So all of the ones that you mentioned are Colorado ones. I know that's your bread and butter. Is this something that exists?
Every state has.
Okay.
Every state has their version
Okay.
of a down payment assistance program. As far as I know, every state has it.